Banks are collapsing. Here's why. By someone with a name that I love, Coffeezilla. And remember, if you like this video, please be sure to smash one of these. And if you want to see more, make sure to get yourself one of these. They're absolutely free, on sale indefinitely, 100% no cost. Just for you, though. Don't tell anyone else about this deal. It's just for you.
Two of the largest bank failures in history happened this week. But before we talk about why, I have a question. Why is Jim Cramer so good at being so bad at his job?
That's the host from Mad Money, right? I think. Yeah, I'm pretty sure that's the host from Mad Money.
Months before they both collapsed, he said this.
These are never, ever talked about. Why? Because it's too boring? I like to make money. Boring is good. Watch out for Siganture Bank. That's my fave. SVB Financial, don't you want? This company's a merchant bank with a deposit base that Wall Street has been mistakenly concerned about. This morning.
Did he just ponder both banks that failed? Siganture and SVB, Silicon Valley? Wow, he is really bad at his job.
We witnessed the second largest bank failure in American history, which naturally created a wave of fear as the day went on.
Rightfully
Hence,
so.
Ultimately losing 345 points, S&P falling 1.45%, and the NASDAQ tumbling 1.76%.
Now, I have to admit, he has a way with sound effects. Now I understand why they call it Mad Money.
Yeah.
But there is one thing Jim Cramer isn't wrong about, which I know is shocking. Fear is in the air, and many are worrying, is my bank safe? So today I thought we'd break it all down, the recent collapses, why the government has announced a special bailout, why some people are happy with it and others are mad. And
from my understanding, which could be wrong, we will find out here. But from my understanding, the bailout is coming from the FDIC fund that banks pay into. So it's not taxpayer dollars. And that bailout is only covering the deposits. It's making them whole again. Anyone who's deposited money in that bank, it's making whole. It is not protecting, once again, from my understanding, it's not protecting the shareholders and it's not protecting the investors, which is as it should be. When you make an investment, you take that risk upon yourself that it might go south. The government shouldn't bail you out of that. As a shareholder, well, once again, you made an investment. Not all investments work out. Government should not bail you out. And as an executive of the bank, well, I really hope they rake you over the coals, because I read that you guys all got bonuses the day that the FDIC took you over, or the day that the government took you over. You gave yourself bonuses earlier in the day. Maybe not true, but that is what I've read.
And, of course, what's next? Let's start with the facts. Three major banks in the United States have failed in a short period of time. Silvergate, Siganture Bank, and Silicon Valley Bank.
I didn't know about the first one.
Silvergate was the smallest with about $11 billion in assets. Siganture was like the mid-sized one, and Silicon Valley Bank was the largest. Now, Silvergate and Siganture Bank were well known in the crypto space, while Silicon Valley Bank was massive in the tech startup world.
Yep.
However, despite their differences, these banks failed for similar reasons at a high level, which is this.
Okay, before he gets into it, let me see if I know why first. So my understanding is that they do what all banks do, and they take deposits from people, and they use a portion of that deposit to do investments. They invest in bonds, they invest in real estate sometimes. They make all sorts of varying investments, which are usually typically very low risk. From what I believe I know, one of those investments that they invested a lot in is bonds. And the bonds were at this current time at a very low value, which is not a big deal because you wait the lifetime of the bond, you cash it out for a profit. If you have to cash a bond out during its life cycle before you're supposed to, you're going to, especially with the cost being low right now, you're going to take a hit on that. And basically they had a few years of high deposits during the pandemic and around the pandemic time. More recently, there's been a lot more withdrawals to the point where the withdrawals actually exceeded the deposits. So the bank had to sell off some bonds. Now, That's bad because they're having to cash out these bonds, which are usually very low risk, but they're having to cash them out at a huge loss. Basically, the withdrawals increased and the bank was not able to uphold, so they were looking to investors to make more capital. And when word of that got out, that's when everyone started panicking and selling off their stock and wanting to withdraw their money. And then you have a surplus of people wanting their money out compared to people putting their money in. And bank has no funds. They cannot possibly pay out everyone trying to cash out at the same time. And here we are today.
We all experienced a run on the banks when too many people demand too much money too fast, and the banks don't have cash on hand. Now, I want to make something clear. It would be easy to draw the comparison to the crypto crash in 2022 when several crypto companies like FTX collapsed, but there's an important difference. Companies like FTX were insolvent. When there was a run on their banks, they had no money to give. Whereas the banks we're talking about were illiquid, meaning they had the money, but when they had the bank run, some of it was locked up in long-term assets like bonds.
It's a big difference.
To be clear, these are not the same things at all. But things can get a little fuzzy in the details. For example, when a bank run happens, what can start as a liquidity problem can become an insolvency problem if the bank has to sell what they have for cash. And let me explain. One of the safest investments is considered to be treasury bonds. Your grandparents probably invest in it. Banks invest in them, both for the same reason. They provide a stable rate of return. So say you're Siganture Bank, right? You've got billions of dollars in customer assets. Where do you put it? Well, into treasury bonds, which let's say earn you 1% a year.
Very safe.
Keep some cash on hand for withdrawals, but you figure, look, if I need to sell these, I can sell my bonds, right? But what happens if interest rates rise really quickly? Well, suddenly you have this 5-year bond you bought a year ago, which gives you 1% a year. But now the government is selling the same 5-year bond and offering 5%. Because of that, now your bond's value on the open market drops. It's no longer even worth what you paid for it because it's giving less interest than other bonds. And so if you try to sell that, well, now you lose money.
A very important distinction there, though, is when your bond becomes mature, it is still worth the agreed upon maturity price when you purchased it. So if you keep that bond to term, there's no loss there. You're still getting exactly what you expected. That's the important factor here. It only impacts you if you have to sell it early.
Now, to be clear, if you held the bond to maturity, well, you would still make that 1% and not lose anything. But when depositors are asking for cash, it's simply not an option to hold on. Now, I know that seems complicated, but the essence of it is this. Banks were forced to sell long-term assets that they didn't want to sell, like bonds, and they took losses because of these bank runs. Because of that, what started as a liquidity crisis became an insolvency crisis, and that's why they got shut down, because they weren't going to be able to service all those withdrawals. So now what, right? Doesn't the government guarantee bank deposits? Why are we even talking about this? Well,
another detail about this is the panic factor, right? The bank was talking about getting investors to get more capital so that way they could have the cash on hand in order to take care of these withdrawals. But both investors and customers of the bank panicked. The investors panicked and started selling off their stock. The customers panicked and started wanting to withdraw all their money, which of course only compounds the issue and just exponentially grows it worse and worse. As crazy as it is in these types of situations, panicking is the worst thing that you can do because there's two options. One, everybody panics and horrible things happen. Or two, we all keep level heads and the bank makes it through it. We're all fine. Now, of course, this is the real world, so neither one of those options is going to happen. The world's a bit more complicated than that. So you have a lot of people panicking and some people saying, hey, we shouldn't panic. And then you end up in the situation that they're in today. Also, the FDIC does guarantee deposits, but it only insures up to $250,000, $250,000. So, especially since Silicon Valley is a tech startup bank, we're likely talking about accounts that are in excess of that. So even if they insure up to $250,000, a lot of these customers are going to lose a lot of money, and they are not going to be whole at the end of this process. Now, from my understanding, they're going to actually make the customers whole again instead of cutting off at that $250,000, which I think is a really great move personally, especially if it's coming out of the FDIC fund. If it's coming out of taxpayer money, my opinion might be a little different on that, but to the best of my knowledge and belief, these funds are coming from the FDIC fund, which is a fund that banks pay into to fund the FDIC insurance for these purposes. Sort of like how you pay into unemployment.
They kind of do. The FDIC insures up to $250,000 per account. However, at places like Silicon Valley Bank, they had a lot of accounts with a lot more than that. Because as we spoke of, they hosted a lot of venture capital startups that might have had anywhere from 10 to...
Whoa, okay, so we got some pretty big guys here. We got Roku, Roblox, Rocket Lab, Lending Club, Payoneer, iRhythm. Wow. Yeah, they got some pretty well-known names in there. And look at those dollars. Well in excess of $250,000. I mean, the highest one here is what? 3.3 billion. Circle. I have no idea who that is. Wow.
To $50 million in there. And suddenly, that company, which was healthy yesterday, now can't get access to that money and can't meet payroll because their bank had failed.
I've been in business management for the better part of my life, actually. And one part that I don't get is why are they not diversifying their holdings? Why do they have that much in one bank? Like Circle, what were they, $3.3 billion? What's the reasoning for having that much cash in one bank? Or do they have ties other than cash with that bank, maybe? But that just blows my mind. Now, granted, I've never ran a multi-million or billion-dollar company, so maybe there's a lot more to it than I understand. But in my mind, I wouldn't want that much in one bank. It just doesn't make sense to me. It's way too much risk. I would personally diversify my holdings, for sure.
And this triggered a huge response from many in Silicon Valley to call for depositors to have their money guaranteed, with people like Jason Calacanis saying, you should be absolutely terrified right now. That is the proper reaction to a bank run and contagion. Guarantee all deposits up to $10 million or this will spiral into chaos. And comments like this sparked a huge debate on whether the government should or would get involved. Ultimately, with the answer coming on Sunday when the U.S. Treasury said this, quote, depositors will have access to all of their money. And there you have it. The U.S. government is stepping in to save not only Silicon Valley Bank, but also Siganture Bank as well. They did this citing a systemic risk exception, which really boils down to a single idea. Please don't panic, guys. Please don't take out your money.
It's so true. That's the end goal here of the government, is they want to stop a panic. A panic could easily spread out and become much bigger and start causing these types of scenario elsewhere in the country with other banks. So the last thing they want is people to panic. And if the funds are coming from the FDIC fund, which is for this purpose, and not from the taxpayers, it's not a bad idea. Now, it shouldn't be the regular run-of-the-mill response, I don't think. But in this particular case, it needs to stop a panic, and it is making that goal happen. But also, you could argue that the companies knew the risk when they invested that much in a bank. Banks are not supposed to fail. They shouldn't fail, but they do. There is a chance that banks fail. And as a banking manager or the CFO of these companies, you know that, and you should diversify your holdings. I am not an expert by any means, but to me it just seems ridiculous that you would have 3.3 billion sitting in a single account at a single bank. How could you not see that as a huge risk? I don't understand. How could you not see that as a risk?
Ultimately, the U.S. government doesn't want you worried about your bank deposits. However, not everyone saw this as a win. Many were quick to point out that, once again, the government only seems to step in to help a certain type of person. Quote, Mark Cuban, bail out Silicon Valley Bank tonight. Feds, approved. Goldman Sachs needs $824 billion. Approved. JP Morgan Chase needs $416 billion. Approved. Average Joe, my wife has cancer. Can we get Medicare? We're broke. Now, I do have to tell you that those in favor of the Fed's actions will tell you that this is an unfair characterization. that it's not the super rich getting bailed out. They'll point out that this isn't a traditional bailout at all because it only applies to the depositors and that executives and shareholders will get nothing. And that sounds good, except for the fact that some executives and shareholders in Silicon Valley Bank had already cashed out, with Greg Becker, the CEO.
Well, of course they did. If you're in charge of a bank or on an executive at a bank and you see that bank is going to go under, if you see the writing on the wall, you're going to withdraw your funds. I mean, come on, you're going to sell your stock. You're going to get out of there and cut your losses, right? That being said, I think that's reasonable. Anybody would do that. I think that the executives at this bank need to have a very thorough investigation criminally to see if there was any criminal activity or malicious intent that happened here. As far as bailouts go, it's not catering to the rich. It's protecting the American people. And that's why I'm okay with it. You bail out a bank like this and protect its depositors, because if you don't, even though the company should have realized the risk, you're impacting that company, all of their employees, which is many judging by the names that I know on there, and you're impacting the livelihood of those people that had nothing to do with this. I mean, thousands of people could have lost their jobs. Thousands, if not tens of thousands of people could have been wondering when their next paycheck was coming in, if they were going to get paid from their job. Companies could have gone bankrupt because their bank went under, and that would have caused more unemployment, and it would have hurt the economy in that area, for sure, without a doubt. And that's why I think it's okay for the government to step in and use that FDIC fund to bail them out. That's the purpose of that fund. Sorry, not to bail them out, but to cover the depositors. But at the same time, every single person that was in charge of that bank needs to have a very thorough investigation. See if there was any criminal wrongdoing. See if they benefited in any way from this outcome. And take a very deep look at that and see if anything else needs to happen as a result to those people.
Selling $3.6 million worth of his shares right before their collapse. And this gets even worse when you consider that Greg Becker was one of the people who lobbied to deregulate his own bank. According to Heather Landy of Courts, quote,
of course he did.
The ability of these banks to fly under the radar in the U.S. was no accident. Greg Becker, SVB's CEO, lobbied U.S. officials several years ago to raise the asset threshold at which banks would be considered systemically important. So let's get this straight. They faced less regulatory scrutiny because they weren't systemically important, according to them, but when everything goes wrong, they're systemically risky and must be bailed out. It's a classic case of wanting it both ways. Now, again, this isn't the same as the full bailouts we saw in 2008.
Now, personally, I believe that lobbying in and of itself, as far as the system in the U.S. is concerned, is absolutely a crock of shit. Okay? It's horrible. It 100% encourages corruption. 100%. There's no doubt about it. It encourages corruption. And I think that things such as banks and other super important things like healthcare, utilities, should be very heavily regulated by the government. It's such an important part of people's lives. Having access to your funds, having access to power, clean water. It's a very important fact of life, and it should not be left to the open market. The government should be more involved in those aspects, I believe personally. And I am generally against government involvement, but in things like that, it's just too important.
And regardless of whether you land on whether there should have been or should not have been a bailout, the idea that systemically risky banks should get special treatment and regular banks, I guess, don't, sends a pretty clear signal. If you're rich, you should move your money into banks that are too big to fail. Otherwise, you run a systemic risk of ending up on Jim Cramer, feeling like this.
Oh God, that was fun. Well, great. Thank you so much for watching. I really appreciate it. If you have any thoughts, please share them below. I love interacting with you guys and I love hearing what you think.